Hello everyone, welcome to our webinar, actually our second part. Remember last time, actually the webinar is all about putting it all together as the title says. So entry, target, stop loss, risk and money management, etc. So today we have the second scale of the webinar in which we're going to cover the risk and money management. I have uploaded two handouts on. Okay, so let me just open the question box as well. Perfect. Okay, I would really appreciate if someone could confirm me whether you can hear me loud and clear as usual. Remember, just to make sure that everything works properly. Here is our email address, so feel free to reply to anything. Feel free to ask anything you want. I will be here to reply. Yeah, I would really appreciate your feedback in regards to the audio and whether you can see the screen and download the PDFs as well. So now let's get back. Before I start our webinar, I would go through the disclaimer, okay? As usually, thank you for confirming, Makun. Disclaimer. This material is provided as a general marketing communication for information purposes only and does not constitute an independent investment research. Thus, nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, taking into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure. So where are we? So not a lot of interaction, it seems, only Makun. So I'm not sure how many of you have been here last week, guys, when we covered the very first part. It was a bit lengthy. Feel free to check our recording, our last week recording. But what we cover is what you should consider, what steps you should follow for finding and entering trades. Oh, thank God. Thank you, Richard, for confirming that the downloads, that the documents are fine, because me and Stuart both have had a technical issue, remember, the last few weeks. So it's good to know. So yeah, steps that you need to consider for finding and entering trades, setting targets, how you can do that, setting stop loss, and the last bit, which is today, is risk and money management or position management as well. I'm gonna go through everything that I can. So these are the slides from last time, but it was a pretty lengthy webinar, so I'm not gonna go through them again, guys. Anyway, we are here 24/5, so you can send an email to me and Stuart and ask if there is anything that you don't understand. So I will try today to go straight to risk and money management. We have seen, just to remind you, that we have seen some common signal examples, So over here I have put a list of things that are considered like that are considered to be signals. Okay, trigger points, things that they can be used as triggered levels in order to alert you that, oh, you need to consider entering the market on this direction since this and this and this happened. So breaking support and resistance levels, overlay of indicators, some kind of a confirm pattern formation, also considered to be a trigger point, breaks of highs and lows. So we have seen all this last time, and I gave many examples. So feel free, sorry, feel free to check the last recording as well, and everything that you don't understand, just let me know. I think I have put also my own system. If I wasn't remember, I put that on and shown some examples. So I need to quickly go. I need to shift into the. Sorry, I need to go straight to the risk and money management slide so we can officially start. Come on. Okay, so this is a time frame on based presenting the steps that each one of us should follow or is good to follow in order to enter until it enters a position. So first of all, you need to clarify to yourself what interests you the most, which time frame interests you the most, which kind of assets interest you the most, and you need to stick with it. So once you identify the time frame and the asset that you want to trade or you like trading, okay, you are monitoring, you are actually reviewing your charts for that particular time frame, identifying trigger signals, applying your daily setup as well, and looking for signals that confirm bias, either upside bias or downwards bias. You can also look for multi-time frame confirmation and divergence. So what we mean is just if you for example, being in 1 hour chart and you move on to the daily chart, reviewing quickly the daily chart could give you an idea on the overall outlook, whether the asset is in an uptrend, for example, or in a downtrend. So that gives you a clue of the overall direction before examining your own time frame, which in this case it might be 1 hour, for example. So to be aware whether you are considering going against the overall trend or along with the overall trend. Identifying trigger levels, support, resistance levels, highs and lows. So we have a bunch of examples that are considered as trigger levels, such as fractals. So these trigger levels is something that you should do in advance because once they breached and broken, you can use them as entry levels or targets and stop losses as well. So they are multi-use. The reason why you identify trigger levels, either by using as your triggered levels fractals, either by using support and resistance levels based on pivot point analysis, either by considering as trigger point the high of the day and the low of the day. There are plenty of examples. So breaking the first support of the day, for example, indicates that the asset presents a bullish bias with a potential retest of the second and third resistance of the day. So that's why we're saying that these trigger levels that have been based in technical analysis are actually considered as entry levels. So it's something that you should do in advance, like early in the morning when you wake up, you're checking the markets, you're identifying for each of the assets that you like, support, resistance levels, highs and lows, etc. And you can either set some kind of a pending order or just write it down to be aware where it currently is and where and uh, where the support and resistance levels are, or put in an alert saying that if he hits that level, alert me. With this way, you'll get an alert once these levels are being triggered, so you might consider them as entry points or stops or targets, as I already mentioned. But once you're done with the review, with the monitoring, with the scanning, and you are actually ready, you found your trigger level, it has broken and you're ready to enter, okay, it's not only about entering the market, it's not only about opening a position, okay, it's also something that you should have done in advance before opening the position, is risk, determine attitude to risk. So, okay, you have identified entry levels, you identify your entry level, your stop loss, your target. But before actually open the position, you have to determine also, you have to actually proceed with risk management. This will help you also set appropriately stop and target levels, okay? But it will also ensure that if anything goes wrong, you will remain in cash, okay? So after collecting and organizing the technicals, you need to apply your objectives, what you are aiming to achieve, what expectations you have from trading, from your own trading, and how much you can um, you can stand um, you can stand actually how much you can stand losing some money. So your attitude to risk. So the process is pretty much familiar, okay? Analyze the long, intermediate, and short-term charts, identify bullish bear signals, set your pivot points, so your support levels, resistance levels, and etc. If the price triggers some of these points, okay, you can identify potential price levels, okay, for PDPL. What we mean by PDPL is predetermined pre-trade levels. So once you have analyzed your charts, once you have identified the bias either in the long term, medium term, or short term, intraday, this is what we call short term, it's the intraday basis, then you put on your triggered levels, so support, resistance, highs, lows, and etc., depending what your strategy is, and identify also potential targets if your price triggers any of the points that you have identified. So then okay, these are pretty much the same thing, because by identifying support and resistance levels, okay, And if you identify multiple support and resistance levels, with this way you have your entry level, you have determined your potential entry level, you have determined your potential stop level, but also you have determined your potential target level. Or if you're not using as trigger points any support and resistance levels, then you can determine these levels using indicators such as ATR. ATR is a good tool for identifying our stop loss and our target levels. The ATR or multiple times of the ATR, depending on our risk and reward ratio. You can consider various scenarios for initiating, adding, reducing, hedging, and exiting from a technical perspective at technical levels. Right? So also, you need to overlay your attitude to risk. It's a sell in a bull move. Do you really want to be involved in something like that? So you need to overlay your attitude to risk. Otherwise, if you don't make these tests and get familiar with your risky personality, let's say, you will end up driven by your emotions. Can stop losses and take profit being seen by other traders active in the current market? So you are referring your own stop loss and take profit strategy. No one can see where your stop losses are and where your take profits are. No. Each one of us has his own account. I'm not sure whether this is what you're asking, but no is the answer, if I understood correctly. You cannot really see stop losses and take profit for other traders, no. Unless if you're confusing these things with the copy trade service that we offer. Because if you let me find the, because guys, I'm not sure how many of you have seen this, but okay, more questions are coming. I'm on it. Just to quickly show to Chatirj the copy trade, edge of copy. So this is something different. This is only for those that they want to copy someone else trades. So this is a service that we offer for those people that they don't want really to trade themselves, and they want to copy from a more advanced trader. So you can follow someone if you want, but that's something very, very different. It's a different product, it's a different thing. So I'm not sure whether this is what you're asking, my dear Shadid. Please let me know. Okay. Sorry. So, oh, you're very welcome, Shatirji. We have another question. What's the difference between trimming stop loss and normal stop loss? Trimming. Are you sure this is the correct word for what you're asking, my dear Chakwu? Are you referring to trailing stop loss? Please clarify and let me know. So just briefly, if you're referring to trailing stop loss, a trailing stop loss is the stop loss that we used. It's still a stop loss, okay? It's a stop loss, but the normal stop loss, I mean, if we open a position and we set the stop loss at 1.24%, that's fixed, right? So James, what I uploaded is everything. Last webinar, this webinar, and an extra webinar that Stuart had on risk and money management, okay? Okay, James. So I'm getting back to Chugu. So Chugu, normal stop loss is the fixed stop loss. You know, if we set, for example, our stop loss at 1.24%, it won't change. It will remain at 1.24%. Trailing stop loss is something that I kind of love. Sorry for that, but it's my strategy, my personality as trader, but I find trailing stop loss something very, very good. So trailing stop loss is when instead of using a particular level as your stop loss, you're actually setting your stop loss at a distance below the current price. So trailing stop loss is when you're setting your stop loss 20 pips below the price, 10 pips below the price, 30 pips below the price, or for example, dollarized. I want to set my stop loss $20 below the below the asset price. What that means, it means that if the market turns against you, you're gonna lose $20 only. So you're pretty much setting your stop loss at a fixed distance away from the price action. So as the price action goes on and on and on and moves, so maybe you are in cable pound dollar, sorry, the pound dollar is moving up and you open a long position and you have set your trailing stop 20 pips below the uh, the the price action. So as long as the price moves higher and higher and higher, the stop loss will also move higher because it needs to keep that 20 pips distance from the price action. With this way, you are locking profits. Okay, that's a different though webinar. There are plenty of webinars on trailing stop. So if this is what you're asking me, my dear Chuku, please feel free to watch some recorded webinars that we have on trailing stops, because there are very many different trailing stop techniques. That's a good title actually that's a good new topic. So for a new webinar, examining, let me write it down, different trailing stop techniques. What do you think? Shall I go for it? So yeah, okay, let's move on. So guys, yeah, it's all about managing risk today. So let's move on. Up. Here we are. Okay. So, so managing risks. For managing risks, what is required, okay, is for you to predetermine. Where is my predetermine your entry level, your stop loss, your target area, and your risk and reward ratio. How much you are willing to risk for every trade that you're gonna take, and how much you want to be rewarded with every trade that you want to every trade that you want to enter. But on top of just predetermine some fixed entry levels, target levels, stop loss. I have mentioned in the past, I'm not sure if anyone have seen one of my webinars in regarding to pending orders, but other than an entry level, we have also some other order types, okay, which we so other than the usual traditional manual, entry level, I mean, what I mean by that, so for example, you are watching the charts and you say, oh, I'm gonna go long, and you just buy. Other than this, we have the so-called order types, which are 4. So the pending orders. So what is a pending order? Pending order is when you have scanned the market, you have done your technicals, you have done your fundamentals, and you have identified your support and resistance levels, but you cannot really stay in front of your PC or in front of your mobile phones and waiting for the market to hit your triggered levels. So instead of that, you're opening a pending order. So that means that you will not need to be in front of your PC all the time, because by setting a pending order, you will ask your MT4 to open a position for you if some conditions are met. So, for example, open long position if asset breaks, moves above 1.50 level. So you are setting some orders to the MT4, and if the conditions that you have added are met, then the MT4 will open automatically the positions for you. So these pending orders are 4: buying stop, sell stop, buying limit, and sell limit. This is a risk management tool. Why? Because you determine in advance your entry level, your stop loss, your target, right? And you don't need to worry. You leave it automatically to open itself and to close itself. So you are limiting the risk to involve your emotions in your trading. So it relieves you a bit. So yeah, let's start with buying stop. What is a buying stop? If you have added a pending order in which you are saying that once the asset breaks above this level and keep moving higher, open a long position. So in this case, we have a shooting star formation. Okay, so a shooting star formation is a sell signal, so it implies a reversal. So we have seen something like that in our MT4. So with this, if you see something like that, okay, because it's a bearish signal, it's a sell signal, the top of the shooting star could be used as stop loss level. The high of the sell signal, okay, so the top of it could be used as a stop loss. But just to avoid any noise in the market, it's good to put it slightly above it. So one method for setting a buying stop in this condition is by by finding the high of this shooting star plus the ATR value, and you can use that as your stop loss. Okay, so you have identified this formation. You have added ATR plus the high of the candle, and you have identified this level as a potential stop loss. Okay, I'm gonna explain why I'm saying all this. Jaimu, I'm not a mobile phone trader, to be honest. I'm not sure whether it is available on the phone. If you have any positions open, go and click modify, okay, and check whether it gives you that option over there, because in MT4, if you have open a position, okay, and you go into your order. So I have this position open right now, okay? You click modify, you try right click, you have modify, and you have trailing stops as well. Or you can click modify, sorry, and you can set no, here's the pending order. So by right clicking, I can see trailing stop over here. Check if there is any option like that. Yeah, I'm not sure, dear. I'm not sure. I'm not trading in mobile phone. So let's get back. Sell stop. Sell stop is when you have identified, let's assume some support levels, and you have set a pending order saying that if the market breaks that level and moves further to the downside, so continues further to the downside, I want you to open me a short position. So in this case, how you can identify that entry level, that sell stop? Let's assume that you're seeing that your assets keep moving lower and lower and lower, or you have identifying some kind of I don't know, a signal, a formation. In this case, it's a hammer. So if you have identified a hammer, then how you can identify your potential sell stop is by taking the high of the low of the single candle minus ATR. So taking the low of the hammer minus the ATR, so it gives us a trigger point over here, a sell stop, a stop loss level. So I'm saying that is how you will do your homework before entering the market, okay? These are the pending orders, guys. So there are another two. So if I'm here right now, if my asset breaks the stop that I found initially here, you have found these as a potential entry level at the end, okay? So if that breaks, oops, open a short position for me. Come on. Or if you have identified another support level, you can also open a bullish position, a pending order actually, which is bullish, which is long, by stating that right now I'm on the support level, okay? I was here, I went down, okay, I didn't manage to break that level. So if, for example, you are here and you're saying, okay, I'm very close to a support level. So I will open a pending order, two pending orders, one buying limit and one selling limit. So I will open the very first pending order that I will open is stating that if the asset breaks support level and it keeps moving lower, open me a short position. The second pending order that you're going to open will be the vice versa, stating that, okay, if it touch my support level but doesn't go down, but instead goes up, then I want the buying limit. So that means open a long position. Okay, so with this way, even if you missed the trigger of your support level, you don't necessarily need to worry because the MT4 will open the position automatically for you. So you can find all these options, right? Trailing, buying limit, sell limit. So everything is here, guys. Everything is here. I'm not sure how many of you are using pending orders, but it saves you from a lot of hassle. It saves you. It's risk management. It can be used as a nice risk management because you will have to set in advance your target levels, your entry points, your stop loss. So it helps you organize yourself. So that's one way of having an appropriate risk management by using pending orders. Okay. Sorry, I replied to someone because he needs a private email. Okay, so one of the risk management tools is considered to be the pending orders because, as I said, by placing a pending order, the trader has an easier time to set and control the risk and reward ratio. It won't be emotionally driven because everything will open automatically without him being in front of a PC and watching step by step everything that is going on. So another thing that you need to consider for having an appropriate risk management. What risk management means, other than doing your homework, pending orders, setting your risk and reward. It's actually setting your risk and reward ratio. So what we mean by that, you need to decide in advance how much you are willing to risk every single day. We are not rich, right? I believe that everyone that is here are people that you're saving you are investing your savings, right? That's why, since you're risking your savings or any extra money that you manage to save, you need to be risk management is something that it's crucial for all of us. So if, for example, you have decided that you have saved, let's say, I don't know, $1,000, you want to invest in the market in order to gain more money back, then you need to behave responsibly. So the very first thing that you need to do is identify how much of your portfolio you are willing to risk every day, and it should be a wise number, guys. Okay, if you are, for example, you have $1,000, you cannot risk all of your money in a single trade, right? You need to identify a fixed level that you are willing to risk every day per trade. So for me, for example, I will say, okay, I have $1,000 and I'm trading on a daily basis. I don't want to risk more than $50 every day or $100. I don't want, actually $100 too much for me because it means that would be 10% of my balance if I have $1,000. Okay, so I will say that I don't want to risk more than $50 every day. So that's up on you to decide. You need to find a fixed level at which you will be okay, you will feel okay. So if something goes extremely bad that day, you will lose only those $50 and not all of your account. So you need to stick to a particular fixed percentage level that you are willing to risk per trade and per day. So don't come and say to me, okay, I am okay risking $100 per trade. Okay, $100 per trade. I have 1,000 and I have opened 10 positions today. 10 positions, and you're risking 100 for every position. That means your whole amount, all of your $1,000. So that's why it's key to identify how much you want to risk per trade, but also per day. Okay. Otherwise, if you open 10 position of $100, then if something goes extremely wrong, you might lose all of your money. So you need to identify how much you're willing to risk per trade and per day. For example, 1% of your trading account per trade and 5% of your wallet per day looks like a good percentage, because it means that even if you lose an amount, you will stay in the market for the rest of the day, because by losing a trade, you will still have money the next day to reinvest again and to try to recover what you lose the previous day. So I'm giving a numerical examples over here to make you understand how important risk management is. Let's assume they have 5,000. I've said that, okay, regardless of how many trades I'm opening a day, I want only to risk 5% of my 5,000. So that means 5% of the 5,000, $250 per day. That's my maximum daily loss permitted. So even if you trade more than one position a day, you need to make sure that you stay within your risk limit, within those $250 per day. So if since you're risking 1% per trade, 4 trades, if you have opened 4 trades, so if the overall risk of these 4 trades that you have taken that day have hit the 5% daily risk, then you need to stop for the day. You should not open any more positions. Okay? Or otherwise, if you have lost, you have risk, you have hit your risk percentage, and you have lost those $250 that day, you need to stop for the day, close everything, don't trade anything else because you have reached your daily risk, and wait for the next day. It's a new day, it's a new opportunity. So stop if you have lost your daily risk. Don't overtrade. Set a maximum number of trades you can make per day. Don't try not to have more than 2 entries per idea, not per day, but per idea. If you have entered euro dollar and you want to add another position on euro dollar, fair enough, but don't overdoing it. Otherwise, you will suffer multiple losses. Okay? With this way, you will avoid impulsive revenge trading. So what we mean by that? If we, for example, we have opened a position on euro dollar and we are doing good and we want, I'm doing good, okay, I'm gonna open another position in euro dollar. Okay, another position. But suddenly, I don't know, Miss Lagarde is on saying something stupid and everything goes on the other direction, and we lost those 2 trades. And we're like, okay, if you have lost them, stay out of the market and wait for the next day. Don't try to do the revenge trade. Don't try to say, okay, I have lost $100. I will manage to take them back. I will open positions right now and I will get them back. I will get back what I have just lost. No, it is what it is. Accept it and try the next day to scan your charts again to find for new opportunities. It's a new day. Clear head right now and try the next day to find something new, something that gives you confidence, and open a position the next day. Don't be driven by revenge trading. Yes, sure, Michael. Okay, I know, I saw it. Okay. What the example about the ATR that I show you is, okay, I'm not sure whether I have something live right now, but I think I do actually. I think I do. So the example that I gave yesterday, let me check something. I think I noticed somewhere. Yeah, okay. Can you see over here, my dear Michael? Here we have pound Swiss weekly chart, okay? Can any one of you guys tell me what is this? Anyone? Does anyone can spot what kind of candlestick pattern is that? Yes, Makun, bearish signal. It looks like an evening star formation, right? Evening star formation, which is a bearish signal. So if you notice any kind of pattern, head and shoulders, shooting star, evening star, 3 crows, 3 white shoulders, there are plenty. You can do your homework in advance and say, okay, so this is a bearish one. Okay, so that means that we have the peak of the pattern is here. My ATR is suggesting, so we need to be over here when the peak was it 0.018, so 0.1828. So okay, so if we consider, so 126 plus 0.1828, so I'm adding the ATR. That means that 127.80, 127.80. So that means that a nice stop loss could be seen over here. Okay, if you are considering entering short, based on what you have seen over here. Of course, we need to see another bearish candle in order this bearish formation to be confirmed. But you can either use the top of the shooting star as your stop loss, or for risk management perspective, you can add the ATR and set your stop loss this high if you're going to take a short position. Also, these levels can be used for pending orders by saying that, okay, you have identified these levels and you say, okay, if in the future the pound Swiss gets back and breaks either that's your call based on your risk and reward, and breaks this level and keeps moving higher, open me a long position. So this you will treat to this level as buying. Let me show it as well. Come on, as buying stop. Okay, so is actually setting some identifying some levels. Oh, what have I done? Setting setting whatever you see, anything that triggers your attention, you're setting some key levels, you're putting your lines on, you are also opening pending positions, pending order, you are setting pending order, because okay, this is a weekly chart. The example that I gave you is a weekly chart. So weekly chart means that you are a long-term trader. So um, it will take a lot of time until these levels are triggered, but because you have set your pending order, you don't need to worry. Once it happens, it will automatically open for you. Okay, I show you a weekly chart because I remembered that I saw an evening star formation, but it's the same anywhere. So for example, we have a euro dollar. Okay, if back in the morning you had this as your support level because it was yesterday's bottom, and we had a fractal. So this was our, let's assume that you were in the Asia Open, right? You were over here, you are living in Asia, and let's assume that you were here. Once you started in the morning, you were here, and you had to identify your support and resistance levels. So one support level was that one because it was yesterday's lows. Immediate resistance was that one, double fractal, also Bollinger. So okay, another resistance. Oops, sorry. Another resistance was that one and that one. If I zoom out, sorry, I had to find more support levels as well, and so on and so forth. But if you were, as I said, if you were here, you were awake, you're trading in Asia session, you were here, and you have identified potential resistance, a potential support level, you could have say, okay, I have another pullback over here, right? Pull back, I had this top, then quickly reverse, going sideways. So you could say, okay, so open pending order. You could use a pending order saying that, okay, you can have a sell stop actually, saying that, okay, if price breaks this support level and moves further to the downside, open me a short position. So as soon as your asset breaks this level and close and moves further to the downside, a short position should have been open. Okay, so this was your entry point, okay, which can also be used as stop loss if we sum this with ATR. So we have ATR was at 0.9 pips. So that means that our stop loss was at 113. Stop loss entry, pending position has already opened, blah, 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 blah. So it's okay. You don't necessarily need to use ATR, guys, but you could have seen in advance, you could identify in advance your support level, your resistance level. You could have opened a pending order, a short pending order. You could have also opened a long pending order. You could say, okay, if it breaks 113.35, open a long position with a stop loss at, let's see, ATR was at 15 pips. So 15 pips below the 113.34, that means 113.20. So stop loss should have been somewhere here if you had your pending order with entry at 113.35 and targets the other two resistance levels that we have set. This is one way to use ATR, but you don't necessarily need to. You can say, okay, if 113.35 breaks, open me a long position, and you can use as stop loss the fractals, your latest down fractal, okay, or your pivot point analysis. Let's see, what is my pivot point analysis? Okay, your pivot point analysis. So pivot today was at 113.20. So pivot can be used as stop loss as well. So are you getting me? Are you with me? It's just ideas that I'm trying to give you. You don't necessarily need to use ATR or pivots. Each one of you has a different setup. Fibonacci's are occasionally used as stop losses or target levels, or yeah, it depends on the structure, on the schedule on the strategy on the setup, actually, to be more precise, that each one of us uses. So where did we left it? What's key? Or you can use your risk and reward management as your stop loss. What I mean by that, if you have decided, guys, that you want to win double of what you're risking, that means that if you have taken an entry, let's take this oil example. If you have taken an entry at $48, okay, so if you're risking double, if you want to win double of what you're risking, it means that if your target was 100 pips higher, so was at $49, that means, okay, so you have 100 pips distance from the entry point up to the target. Then you need to set your stop loss at 50 pips below the entry, because you need to make sure that you will win double than what you're risking. So your stop loss should be at 47.50, 50 pips below the entry. With this way, you might win double than what you're risking. So another way for setting your goals, your targets and stop loss, is by considering also your risk and reward ratio. Okay, so before you enter in the market, you need to identify realistic targets, and based on those targets and your risk and reward ratio, you can put appropriate either trailing stop or a fixed stop loss, but make sure that it will be closer than target level. Make sure that you're not risking too much. So that's why you have to set target profits daily, weekly, and monthly. Let's say I want to make 20% every month. I want to win triple of what I'm risking. So you need to set realistic targets in order to review every day, every week, and every month, and to check whether you end up break even, or you end up in profit, or you end up in a loss. Because if you keep losing day after day, week after week, it seems that you're doing something wrong. Also, key stop loss is not just stop loss. We have some stop loss rules. We have some exit rules. If you have predetermined and set in advance, either in a pending order, either in a normal order, in a normal position that you have just opened, if you have set your stop loss, you have set the stop loss, don't move it. Don't move it. If the trend goes against you and hits your stop loss, don't worry. It is what it is. Don't take it personal. Something went wrong. You will recover the next day. Don't. If you have seen the market suddenly turns against you, don't go and put your stop loss away. Move it um, move it away from the market price, because what you will do is just risking more and potentially losing more if the market continues against you. The majority of the traders lose more trades than what they win. But the important thing is, okay, if you have opened 10 positions, but you have lost in the 7 and you have win only on the 3 of them, that's not important. What is important is by summing up the losing trades and the winning trades to be on profit. The important thing is to manage your overall risk, limiting your losses, but still end up every month with profit. Profit if it's a profit, even if it's just $1, $10, $50, as long as you end up in a profit, regardless of how many losing trades you had and how many winning trades you have, then if you have summed them up and you end up with a profit, that means that you're doing good. You need to always set your stop loss prior entering the trade. Okay, guys? Don't leave stop loss. Don't leave your trade without stop loss. To break even, set a profit target. If trend goes up to your target sell position, move stop loss on the rest of your position. Remember, never risk more than the risk level percentage that you have initially set. Entry rules. These are also significant, but the exit rules are more significant than entry rules. Set certain conditions that needs to be achieved in order to take an entry. Is the pending order that we have set, or if you're taking a normal order, you have some condition to be met, right? You have some common signals that you need to see. I mean, in order to open a position, it means that you have seen an opportunity, you have seen a signal, you have confirmed that momentum indicators agree with that signal, you have identified the momentum. Also, the momentum agrees with your decision. So there are some conditions, right? You cannot just open a position without do some technical analysis, right? So you have some conditions met. That's why you are opening a trade. If, for example, you had your 50-period moving average and it was broken, and RSI and gives the same direction as moving average, then that means that you can enter the market, because moving average has broken, but moving average and RSI agree on the same direction. So that's an indication for you that opening a position it's that yes that gives you trust about your decision to enter the market, because you have done your analysis and everything points, or the majority points, on that direction. Or if tweezer confirmed with the next candle, then I will get in. Or if you have identified head and shoulders, and the head and shoulder and the price broken the neckline of the head and shoulders, and it continue moving lower for the next few sessions, so that was a confirmation that you can enter short. Or a triangle has broken to the upside, and the very next few candles also continue extending higher. That's also a confirmation that you can enter long, you can enter the market. So if some certain conditions are met, then you are good to go. You are good to enter the market. So write down all the opportunity signals that you have identified and how you are willing to trade them. Don't chase an entry. if you missed it. If you missed it, just ignore it. Let's move on to something new, something else. Also, don't chase um uh, um don't chase an entry. What I mean by that, don't try to find something that you cannot really see. If you can see it, it's there. If you cannot, then move on to the next asset. Okay? Position management. Okay, it's again, it's the same things that we have mentioned. Psychology matters. You should value your money. You need to manage your positions, risk management, risk and reward ratio to be considered, set some percentage rules in a matter of how much you are willing to risk every trade and every day. If you don't do that, then you deserve to lose, unfortunately. I know that this sounds a bit bad, but it is what it is. If you don't value your money, how you are expecting to benefit? By following some basic position management, risk management rules, you're reducing the stress. So your mind will be clear and you will make better decisions. And as a sequence, eventually you will see slowly higher and higher profit growth in your account. So it needs patience. The more you're following your routine, your setup, your strategy, it fits back more confident and your self-appreciation grows. Okay, I will finish the session by showing once again some tools that will help you with the position and risk management. One of that is position size calculator, in which you can put the symbol that you are interested in, put the the leverage, put the account currency, and you can back. And by specify the volume, you can get margin results. So what that pretty much do is calculate how big your position size should be, how many lots, how many pips. Okay, and you can use this result in a risk percentage management, in a risk percentage calculator, in which by setting your currency pair, the position that you are, the entry position, the entry price that you are thinking to take, the direction that you are thinking to take, your stop loss, the potential stop loss that you are thinking to set, the balance that you have, how many money you have, but how much of those you want to risk. So if you have 100, but you want to risk only, if you have 1,000, but you want to risk only the 1%, by clicking calculate, it also helps you identify what's the most appropriate lot size and stop loss in pips based on the percentage risk that you have identified, that you have set. Sorry. Also, multi-target calculator. By setting your position, the potential position, okay? So whether you're going long or short, the lot size that you have identified based on the previous calculators, setting your potential entry point, stop loss, and targets, and how much you want to risk per target. So if you want to risk only the 70% in the very first target, the other 20% in the second target, and the remaining 10% in the last target, you can calculate how much you can profit or lose in case that the market turns against you. Okay, so these are useful tools that they will help you do appropriate position and money management. Identify how many pips how many pips this position should be in order to meet my risk and reward ratio. How many pips that position should be. What's the size of my position if I want to risk only 5% of my money. So these are helping you to identify this, to do these calculations for you and identify where you should place. Yes, they will help you identify, as we said, the position size, risk and reward ratio, and so on and so forth. So guys, I want to call it a date. If you have any questions, let me know right now. That was it from me. Hopefully you enjoyed. I would really appreciate the feedback. So I will wait a bit until you have any further questions, and I will call it a date. You will get the recording as usual in our emails. Anyway, on the past webinars website, you can see all of our previous webinars. Feel free to check also the past week's webinar, the part 1. What else? I think that's pretty much it from me. Hot Forex offers an award-winning security of funds, free negative balance protection, insurance up to 5 million. So with Hot Forex, you know that your funds are secured, and it's one of our top priorities. Okay. Thank you very much for attending. Hope you are having a great day ahead, and I'll see you again within the week with our Facebook and YouTube lives. Emmanuel, please send us an email at webinars@hotforex.com. Tell me which slides you need, and I will try to give it to you. Okay, give them to you. Thank you very much. Have a great day ahead. Bye bye.